Day 113 of the Trump administration witnessed a pivotal shift in America's economic landscape. In a surprising reversal, Washington and Beijing announced a 90-day suspension on their escalating trade battle. American tariffs on Chinese imports dropped dramatically from 145% to 30%, while China reciprocally reduced theirs to approximately 10%. This breakthrough follows intense weekend negotiations in Geneva. The administration expressed optimism that this temporary truce will pave the way for more comprehensive agreements soon. "We've completely reset our relationship with China," declared the Treasury Secretary during the announcement. "The Geneva discussions were remarkably productive. We maintain excellent diplomatic relations. Our goal isn't to damage China's economy." The president plans to connect with President Xi before week's end. "Complete decoupling isn't our objective, but strategic realignment remains essential." Wall Street responded with unprecedented enthusiasm. The Dow skyrocketed by 1,100 points, while the Nasdaq and S&P both surged beyond 3%. Retail corporations welcomed the news, though many cautioned that despite anticipated shipping increases, elevated consumer prices will persist. Let's examine this situation clearly. For years, the administration argued America suffered from unfair trade practices. Just weeks ago, they initiated a trade confrontation that sent global markets into tailspins. Today's partial retreat brings welcome relief, but we mustn't forget who created this crisis initially. A prominent economist summarized it perfectly: two realities exist simultaneously. First, America's trade position and economic outlook improved dramatically overnight. Second, our current trade stance and economic forecast remain significantly worse than they were at the beginning of this administration. We should anticipate a massive shipping surge from companies able to stockpile inventory before this temporary pause expires. However, smaller businesses lacking sufficient margins to absorb these costs will inevitably pass remaining tariff expenses to consumers. While today marks a positive turn for businesses across both nations and certainly delights investors, the administration's strategy raises profound questions. Consider the original justifications for these aggressive tariffs. Tariffs generate substantial revenue. They'll fund the largest tax reduction in American history. A nation can't merely invent everything while manufacturing nothing domestically. Eventually, you become dependent on foreign producers. Tariffs represent a beautiful opportunity if implemented correctly. They'll enrich our economy, help eliminate national debt, and enable significant tax reductions. Does today's retreat suggest abandonment of the promise to revitalize American manufacturing? The original commitment that tariffs would reduce deficits and finance tax cuts appears unlikely now. Furthermore, even reduced tariffs of 30% remain inflationary, ironically contradicting one of the administration's central campaign promises. Market analysts express confusion about the sudden policy shift. Some question whether external factors, including international business arrangements benefiting the administration, influenced this dramatic reversal. The stock market's enthusiastic response reveals an uncomfortable truth: financial markets apparently celebrate when the administration backs down from its hardline positions. The S&P 500 jumped more than three. Tremendous news for investors, but disconnected from everyday economic realities for average Americans. Despite today's stock rally, Treasury yields remain troublingly high at 4.47, dangerously close to the 4.6% threshold that previously forced the administration to reconsider its approach. If yields continue climbing, expect renewed market volatility and corporate anxiety. Remember that temporary relief doesn't equal permanent resolution. The previous administration's 2018 tariffs required nearly 2 years to reach even a preliminary agreement. This 90-day pause merely postpones difficult decisions while creating continued uncertainty. For small businesses, America's primary employment engine, this policy whiplash creates impossible planning challenges. Unlike corporate giants with sophisticated supply chains and significant financial cushions, local enterprises can't absorb 30% cost increases or navigate constant policy shifts. Once these small businesses disappear, they rarely return, diminishing local economies nationwide and contradicting the populist rhetoric that fueled the administration's rise. What have Americans gained through this month-long economic turbulence? The objective answer appears troublingly clear: very little. What have we learned about our leadership? That remains for citizens to decide. Don't forget to share your thoughts in the comments below. Subscribe to our channel for more insightful analysis, and share this video with friends who need to understand these economic shifts. Your engagement helps us continue bringing you high-quality content.